Hey guys, this video is to show you how to use the tax table. Now, to explain what the tax table is, before I go into details, if you just want to learn how to use the tax table only, you could fast forward this video to that session or the part where I show how to use the tax table only. But in the first part of this video, I'm going to explain some concepts related to the tax table. And then after that, I will show you step by step how to use the tax table using a case study that I have here on this video as well. So the tax table is published by the IRS. And every document or guidelines with tax that is published by IRS are usually numbered. So this is publication 1040, which means this is related to 1040 form. A 1040 form is used to file income tax with IRS. So this tax table is like a worksheet, if you like. Instead of using the tax formula, you will use this tax table once you've already determined the taxable income. So which means you must have deducted the above the line deduction or permitted deduction, and then you must have also deducted standard deduction. And then the balance becomes the taxable income, which you would typically apply the, which you would typically apply the marginal tax rates to. So instead of you applying the marginal tax rate to the different brackets, like what you see in chapter 1 of most tax textbook, you will instead use this table once all those initial deductions have been done. Again, I'm going to show you an example where you have those deductions and determine the taxable income, and then we then find the tax liability using this table. Okay. All right. So this table goes from $0, which is at least $0, to bets less than. Okay. So that means your income has to fall between $0 and $5. Right. So the next line here is what you call, or the whole of this column is what you call the filing status or status. With the filing status, you have the first sub-column, which is single, which means you are not married and you are not head of household or other options. And then the second one is married filing jointly, which is very common with people who are married. Married filing separately, which is a filing status chosen by those who are married but choose to file separately. And they explain this to some of you who may have watched this video, who may have attended my physical class. Then you have the head of household. The head of household, there are some requirements you have to meet to qualify as the head of household. So you must fall among these four. Any one of these four will apply to you. And if you are single, you will trace your tax liability on the single line if your income is between $0 and $5. And then if your income is not within this range, your income might be in the $1,000 range or $2,000 range, or it might be in the $3,000 range or $6,000 range or $9,000 range, and so on. And it goes all the way. There's a limit to it that you could use this form for. It goes all the way to $100,000. Okay, let's see where that is. Right here, it goes all the way to $100,000. So if you earn $100,000, for example, and then you are single, your tax liability will be $16,909 that you have to pay. Okay, if you are married, you are filing jointly, your tax liability, if your combined income is $100,000, your combined taxable income is $100,000, then your tax liability will be $11,823. If you are married, filing separately, then could have been this amount, $16,909, and so on. Okay. Now let's look at the case study that I talked about. Now, let's say, for example, we have Marcus and Elena are married and they file a joint return and have combined W-2 income of $80,542. They paid additional tax of $512 when they filed their taxes. However, or how much, if you like, income tax did their employers withhold during the year? Use the tax table. Now, I'll read that again. You say Marcus and Elena are married. They file a joint tax return and have a combined W-2 income of $80,542. They paid additional tax of $512 when they filed their taxes. Okay, they pay additional tax. Okay, of $512 when they file their taxes. How much income tax did their employers withhold during the year using the tax table? Now, this is an interesting case. Interesting case is that they paid additional tax of $512, which means they already pay part of their tax liability, and they pay it in a form of what we call withholding. So withholding is when you earn wages, your employer deducts some money from your gross profits and give that to IRS on your behalf. That's what we call withholding. It's like, I would describe it as money you set aside to pay your tax liability by the end of the financial year, which is typically December 31st. Okay. So when you calculate your tax liability at the end of the year, when you determine what your tax liability is, part of the withholding will be minus from your tax liability. And then if your withholding is not enough to cover your entire tax liability, then you will be required to pay additional tax, which in this case for Marcus and Elena, they have to pay additional tax of $512. If your withholding exceeds or more than your tax liability, then you will get a tax refund in that case. Let's put it simple in that form, okay? Now, how do we do this working? This is the solution here, okay, to determine the answers from here. If you are taking things like, okay, the answer cannot be determined with the information provided. Okay, so this is additional information here. So this is the correct answer, which is A. So if you are taking EA exam, this will be similar to kind of question that you come across. There are times that the answers cannot be determined. Okay, that's if you don't have complete information also, but the information provided here is adequate for you to determine what the tax liability is. So right here, the solution is you have $80,000 that this individual earned, and then next thing you have to do, you will need to less the standard deduction from the $80,512. Now, the interesting thing that is stated here, combined W-2 income of $80,502. So there's no additional information about permitted deduction. So typically, we'll say that this appears to be their AGI, okay, which goes into line 11. So now the next thing you have to do, you less the standard deduction from this amount, and then you come down to what we call the taxable income. So your 80,542 is not your taxable income. Your taxable income is after you less your standard deduction. Now, the standard deduction for 2025 for marriage filing jointly is $31,500. Okay, if they were single, that would be a different amount. Now, you take this amount to the tax table, you find out what is the tax liability for this amount. Okay, this is the taxable amount, and here is our tax table. Okay, and then the taxable amount is 49,000, which is number 3 here, $49,042. And then when we look at the tax table, you have to look at this section where you have 49,000. Okay, so we go all the way up to 49,042. So that would fall within this range here. Okay. So this stop at, okay. All right. So you could see from here, because they fight jointly, this is $5,406. You see that? So we could look at that column, married filing jointly. So that column, this is the column that applies to them because the income is within the range of $49,000 and $49,050. That is because the limit of their maximum taxable income is $49,042. So that falls within this range. So we usually look at the range in terms of the maximum, but in terms of looking at the minimum range, we will use that. So we wouldn't use a situation, for example, where we have $49,042. No, we would rather look at what is the nearest number that the $42 we earn. So it does fall within this limit. Okay, we usually look at it as the stretch or the stretch. Okay. So remember I said the tax liability will be $5,406. So if you look at the amount we have here, it's $5,406. Now, if we say they pay additional, okay, $512, we will less that from this tax liability. When you determine that, then you will know how much has been withheld by the employers. So that's what you have here, which is $5,406 minus $512. We equal to $4,894. Okay, so this will literally help you when you look at question number 5 on the homework that I gave to you. Now, if you look at this section here, how to use the tax table. When using the tax table, you find the income range that contains the taxpayer's exact taxable income. You do not automatically move to the next higher range. So basically what that is explaining here, if the amount is $49,042, you don't want to start from that amount on the left side. You want to start from the lowest amount, but the highest amount should be within the range of gross to the taxable income. So this could be much lower than the taxable income. That doesn't matter. So long that the nearest dollar value is within that range, which is $49,042 in our example, the only difference here is only $2. That wouldn't make any much difference. And that is why the amount we have as the tax liability, okay, this amount we have as the tax liability is very close to what you will get if you use the tax formula or use a tax calculator. Okay. So basically, I did explain this as an example earlier. We would start from $49,050 to this range. We'll rather start from the lower limit. Okay. So the basic rule in terms of using the tax table is to look for the range where the taxable income fall between the lower and then the upper amounts. If you watch this video and then you still have difficulties to understand how to use the tax table, walk down to my office. I will be able to assist you.